What's going on, everybody? Welcome back to another episode of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade for yourself. So make sure that you please like this video, okay? Please like this video. Please subscribe. Make sure you hit that notification bell so you can be in the know every single time that I drop an episode. If you don't know me, my name is Devon Elder. I'm a 28-year-old civil engineer, and I'm just here to help you learn and navigate these waters in the stock market. And so we're coming back again. I've been doing this for one whole year. Okay. This is episode 52 of the Trade for Yourself podcast. So if you are new here, I appreciate you. Thank you. Please continue to stay tuned in if you want to learn more about the stock market. Okay. If you're old here, grab a pen, grab a piece of paper, and just tap in and understand that it is time to learn. Now, in this episode, this is the talk of the town, okay? This is all that we have been talking about, okay, all day long, really all week long, because even price action has been affected because of this. And so the one thing that we need to ask the question is, will the CPI inflation report crash the stock market? And so this is very, very important for us to understand this. And so what is the CPI data that we're speaking of? CPI is the consumer price index that measures the price of goods, measures the price for goods and services throughout the economy. And so how will the market react after the CPI report tomorrow? And for me, it remains to be seen, but I believe that many investors are becoming very, very restless, very, very restless. All the reports, everything that's going on. We've been in a bear market for a year now. I know it's hard to believe, but we have technically been in a bear market for over a year. And so how weary are investors getting? Okay, that they want to be able to get some good news. Okay, they really truly want to be able to get some good news, but if they are not able to get any good news from this report, this could really truly cause capitulation and cause the stock market to continue to come down because inflation has not truly been, hasn't really truly been stamped out yet. And so what are we really truly looking at from this report? And so in general, we want to see inflation come down because we don't want the Fed to be so aggressive this year in terms of raising interest rates. The Fed has already raised interest rates so much. And so we want to make sure that inflation is continuing to come down on this downward trajectory. And we really don't want to see a reinvigoration of inflation because that would signify the market still has a long way to go in terms of this inflation bout. And so CNBC had a very, very good report outlining what we are expecting. And so I want to share my screen and I want us to talk about this particular report and kind of break it down and put it into context. And so inflation is expected to have declined in December, but it may not be enough to stop the Fed. And what they're referring to is stopping the Federal Reserve from raising interest rates. And so the pace of consumer inflation is expected to have fallen in December from the prior month because of a sharp drop in gasoline and energy prices, but the annual rate is still likely to remain uncomfortably high. According to Dow Jones, economists now expect a decline of 0.1% in the consumer price index on a monthly basis, but inflation is still expected to climb at a 6.5% rate from the prior year. That compares to a gain of 0.1% in November and a 7.1% pace year over year. However, the CPI is well off the 9.1% peak rate in June. Now let's put these two paragraphs into context, okay? We're expecting, so when you're looking at CPI, what investors are going to be looking at it from two different scenarios. They're going to be looking at it from a month over month number, and they're going to be looking at it from a year over year number. Now, economists are expecting the month over month inflation to be negative 0.1%. Now, we have not seen a negative number on the inflation reading in quite some time. It's probably been over a year, probably been 2 years, probably going back to COVID, right? Going back to the pandemic for when we have seen actually a decline in the month over month number in inflation. Now that is very, very important, okay? The 6.5% rate, is much lower from the 9.1% rate. We have expected that, but what's going to be very, very important is going to be that month over month data. And so since the economists are expecting a decline, that is the measure is expecting a decline. We really don't want to see an increase simply because economists, the baseline is a decline. And that's what makes this data so important, because the market can flip on a dime based on anything that we see. And so, the Fed has been saying that they want to get inflation down to 2%. They want to get inflation down to 2%. We were at 9.1% back in June of 2022. If we get 6.5%, we're not at 2%, but we're well below the peak rate. Now, September, we had a very, very bad report, because September showed that increase, showed that, reinvigoration from that month over month number that I was referring to. The September CPI showed that reinvigoration in terms of the monthly basis. But we were able to get a good number in October. We were able to get a good number in November. And what we really truly want is a trifecta. We want to have a good number in December, because we're signifying a defined, downtrend in terms of inflation. We have a defined downtrend in terms of the S&P 500. We have a defined downtrend in terms of the NASDAQ 100 and the NASDAQ composite. It will be very, very good if we could get three straight numbers of CPI coming down. We are signifying negative, inflation, and it continuing to come down in a year over year and a month over month basis. Now, core CPI excluding energy and food is expected to be up 0.3% in December, gaining 5.7% on a year over year basis. Core CPI rose 0.2% in November and 6% on a yearly basis. Now, the Fed is going to be watching very, very closely to core CPI, because core CPI strips out the energy and the food component, simply because energy and food prices can be very, very volatile, because those are commodities, right? Look at the price of oil. Look at the price of natural gas. Look at the prices of your, groceries, right? It is very, very volatile. And so the Fed wants to take that out, and they want to look at just core CPI, excluding the most volatile components of the economy. Now, we welcome it with open arms. It's good news, said KPMG chief economist Diane Swonk of the expected decline. It's great, and it helped to fuel consumer spending in the fourth quarter, but it's still not enough. You see, this is just that narrative that we're continuing to see, that everybody is worried that it's still not going to be enough. Now, the consumer price index is expected Thursday at 8:30 a.m. Eastern time, 7:30 a.m. Central time tomorrow. This is going to be happening on tomorrow, y'all. And it is the final CPI report before the Federal Reserve's February 1st interest rate decision. For that reason, the inflation number has become a major event for financial markets, and now some traders are betting it will show inflation slowing even more than economists forecast. They also point to weaker than expected wage growth in December's job report, as well as other data that reflects lower inflation expectations. Now, stocks rallied on Wednesday ahead of the report. The market is looking at it as a glass half full. Inflation is rolling over, and the Fed is almost done raising interest rates, said Peter Boockvar, chief investment officer at Bleakley Financial Group. I think they remember the last 2 months when you had numbers that were well below expectations. They're just assuming that's going to be the case again. Now, I would be very, very wary of assuming what this number could be, because the market could do anything at any given time. And as we say, traders are making that expectation. It's very, very interesting that the stock market was up over 1% today, and also the volatility index was green. Okay, normally, guys, when the stock market is green, the volatility index is red, signifying volatility is decreasing. Same way on the opposite side. If the stock market is red and the stock market is decreasing, then that means normally that volatility is increasing. When you see volatility When you see volatility going in the exact same direction as the stock market itself, that's something that you want to pay attention to. I'm not saying that the stock market that this report is going to be good, nor is it going to be bad. I have no complete idea. The only thing that I'm saying right now to you is that I would be very, very wary of speculating on it. I wouldn't be doing any type of speculating on this specific report. I just wouldn't be doing it. Now, expected impact on the Fed. In the futures market, traders continue to bet the central bank will raise rates by just a quarter point at its next meeting. Meanwhile, some economists continue to expect policymakers will increase the Fed funds target rate by 0.5 percentage point. Now, market expectations are just 20% for a 50 basis point rate hike. A basis point equals 0.01% of a percentage point. It's amazing how much reaction and overreaction there is for one single data point, said Simona Makuta, chief economist at State Street Global Advisors. State Street Global Advisors is one of the largest asset managers in the United States. Now, clearly the CPI is very important. In this particular case, it does have a fairly direct policy implications, which are about the size of the next Fed rate hike. Makuta said a cooler CPI should influence the Fed. The market has not priced in the full 50. I think the market is right in this case, she said. The Fed can still contradict the market, but what the market is pricing is the right decision. Wilmington Trust chief economist Luke Tilley said a 12% decline in gasoline prices in December and other decreases in energy prices for expenses like home heating help drive inflation lower. Shelter is the main focus because of the lag, he said. Rental market data shows a slowing in rates, but the CPI has not yet reflected it. Everyone is familiar with the lag that it takes for the data to show up in CPI, Tilley added. We think there could be a sharper slowdown. Shelter costs are 40% of the core CPI. And shelter is expected to be up 0.6% month over month. And Tilley said that with the decline in the real estate market, he is hearing from landlords that they are having a more difficult time raising rents. We're penciling in slower increases in January and February and March on that shorter lag. And so you want to understand that shelter is a very, very sticky component of the CPI index. And that's why people think that inflation is much better than what people are anticipating, because shelter is one of those ones that's just going to lag and just drag on that number forever, causing people to feel that inflation may be higher than what it actually is out there. Now they're talking about a focus on inflation in services. Now, what are we referring to here? So economists are watching closely to see how much inflation related to services rises in CPI, since goods inflation is expected to continue to come down now that supply chains are operating more normally. The headline monthly changes over the last 2-3 months overstate the improvement. We're not going to get the same help from gasoline in the next report. I don't want to see an acceleration in shelter. I want to see some of the discretionary areas show deceleration, said State Street's Makuta. I think right now the focus is very much on the services side. The market is laser focused on inflation, since the Fed's progress in fighting it could determine how far the central bank will go on its rate hiking path. The rate increases are slowing the economy, and how much more it chooses to do so could be the difference between a soft landing or a recession. The hope is that basically we are now in a position where you could envision a soft landing. That requires the Fed to not only stop raising rates, but ease up sooner. And that doesn't seem to be where they're at, said Swank. The Fed is hedging a different bet than the markets are. This is where nuance is really hard. You're in this position where you're improving. It's like a patient is getting better, but they're not out of the hospital yet. These are very, very, interesting ways they are describing these things. Now, the Fed funds rate is currently at 4.25 to 4.5%, and the central bank has forecast a final rate of 5.1% for this year. The Fed is also worried about a second round of supply shock, whether it's China's abrupt abandonment of its zero COVID policy or something else from Russia. They don't want to declare victory too soon, said Swank. They're making that very clear. They've said it over and over again, and nobody listens. Economists expect another key metric, the personal consumption expenditure deflator, could show core inflation showing even below the Fed's forecast of 3.5% by December 31st. Some economists who expected a recession predict rate cuts before the end of the year, as the markets expect, but the Fed has no forecast for rate cuts until 2024. Some strategists expect Fed's officials to begin to sound more dovish and less at odds with the market view. Boston Fed President Susan Collins said in an interview with the New York Times on Wednesday that she was leaning towards a quarter-point hike at the next meeting. We think one of the changes in coming months is the Fed will soon realize that it is cheaper to change the inflation narrative than reverse a recession, leading to millions of lost jobs, writes Fundstrat founder Tom Lee in a note on Wednesday. And so this inflation is very, very important because we understand that the reason why the stock market was down so much last year was because of inflation, was because of record high inflation, was because of the Fed trying to continue to raise interest rates. But inflation being so sticky, and so it was seeming as if the Fed wasn't able to do anything, as if the Fed wasn't really successful in terms of, really trying to control this inflation. So we got to see inflation come down before the Fed is going to raise off of the gas pedal. Now, remember what they said back in this article. What they said back in this article is that right now, traders and investors are expecting that inflation is going to be cooling. With that being said, since they are expecting the inflation to be cooling, they are expecting the Fed to raise interest rates by about 25 basis points at the next meeting. That will be very, very good for the stock market. The market will feel very, very good about that. However, if inflation is not under control based on what the Fed thinks, this may cause the Fed to raise interest rates by another 50 basis points and keep it going at a prolonged rate. So this is a very, very important report. I feel this is, one of the last pieces of data that the Fed will get. The Fed will get this important data. Next week, the Fed will have PPI, the producer price index. They will see retail sales, so many other things and so many other components the Fed will get between now and that February 1st meeting. But this report is very, very, very important. And so not only do we need to look at the fact that we have, the inflation number coming out tomorrow, we also need to remember that we are in the midst of earnings season. And earnings season is really, truly one of my favorite times because we get to see what the companies are doing. We get to see what management is talking about. And every single earnings season, I get to learn more and more about how management speaks, about how the followers and how the analysts of these companies analyze these companies and ask questions and things of that nature. And so we got to pay attention to earnings season because this is going to be very, very important, right? Because January is going to be a jam-packed, volatile month. And also with tomorrow, with the CPI data, we've also got Taiwan Semiconductor. The chip maker from Taiwan, will be releasing their earnings report tomorrow morning. It's going to be very, very important and very, very pivotal because the chip stocks have not been doing too well over the last 12 months. And so is Taiwan Semiconductor going to show good demand for its products? Okay. Is Taiwan Semiconductor going to continue to raise guidance and say that, hey, we understand what's going on in the economy. We understand that interest rates are high and things of that nature, but we're still expected to have good growth. We still have a good, solid balance sheet. We still have good demand. Is that going to be exactly what the market is expecting? Friday, we're going to have a host of banks. We're going to have Bank of America, BlackRock, Citigroup, JP Morgan, Wells Fargo. The banks are going to be telling us about how the money is moving in the economy. What are their loan loss reserves? How are consumers dealing with everything that's going on in the economy? We'll also have Delta Airlines reporting. We'll also have United Health Group reporting. So we're going to have, Delta Airlines saying, how much are people still traveling? Is the traveling demand still high? What are they expecting over the next 3 months? Okay. What is United Health Group? Is United Healthcare, are they good from a healthcare perspective, right? So many questions are going to be answered. And so we got the CPI data tomorrow. We got a very important earnings reports Thursday and Friday. And then more earnings reports are going to be coming out every single week from now until March. And so all of those things are going to be, coming together, and the market is going to be pricing in all of this data real time. So we really, truly have to pay attention to what's going on. And so before I get out of here, what I want to do is I want to look at the chart. I want to look at the chart of the S&P 500 because I feel it is very, very important. It's very, very important for us to understand the fundamentals, understand what's going to be moving the market, understand, what traders are looking at, understanding what investors are going to be looking at. But we also need to pay attention to the S&P 500 in some technical levels. What levels are traders going to be trading off of? Which ones are they going to be moving off of? And so we've got the S&P 500. This is a 2-year chart, but it's a daily chart, but it's measuring price action over the last 2 years. And so obviously we are in a defined downtrend, and right now we're about 17%, 17.62% from the all-time high. And as I was saying before, we've been in a bear market over 365 days. We've been in a bear market around 371 days. So that kind of goes back to what I was saying about, investors continuing to be, very, very restless. Like, that they're saying, man, we've been in a bear market so long, like how long are we going to be able to take this? And so that's kind of what you got to look at. I've got a question here in the chat, y'all. BizPhone curious, what kind of trader are you? Investor, long-term, swing, or day trader? So I'm a mix of all. I'm a mix of all. I'm a long-term investor. Like I said before, I'm a civil engineer. I'm a civil engineer by trade. I take a portion of my paycheck and I put it into the market. I'm buying stocks. I'm buying stocks in Tesla. I'm buying stocks in AMD. I'm buying stocks in Apple. So I'm a long-term investor with the money that I get from my job. I also have some capital that I have to where I am trying to improve my skills as a day trader, improve my skills as a swing trader. And so I talk about some strategies that I try to go through and things that I am learning. And so my goal is to continue to learn and to be profitable as a day trader and as a swing trader in this particular market. And so, when I'm looking at technical analysis, I'm trying to look at these key levels that I know price is going to be reacting off of. And so when we look at this right here, we've got a key level of 4,000. 4,000 is a very, very key level. And why is this a key level? It's because we've got resistance, and we've got support around this level. Okay, we've got resistance and support around this level. And so, the market closed at 3,969.61. So pretty much around 31 points away from the 4,000 level, right? That's a less than 1%. That's a less than 1% difference, from where we are right now. We're less than 1% from that 4,000 level. And so I'm expecting us to be very, very volatile in the morning. It's very, very possible that we could be up 2% in the morning. It's very, very possible that we could be down 2% in the morning. We could be up 2% in the morning in the pre-market, and then we could reverse everything that we gained. We could be down, very, very significantly in the pre-market, but then gain it back up. And so it's very, very important for us to understand that this 4,000 level is a very, very key level, and it's a very, very key level from a technical perspective. It's also a very, very key level from a psychological perspective, because we've got this red line right here, and this red line is signifying, you know, a downtrend, but we haven't been able to stay above this trend. And so in order for us to really truly actually feel good about being bullish, like actually feel good about us coming out of, you know, this bear market, we're going to have to break above this trend line. And first of all, we're going to have to hold above the trend line, right? We're really truly going to have to hold above the trend line, and we're going to have to retest, and we're going to have to break these key levels of support. So 4,100 right here is another level that we're going to have to break past. 4,200 is another level that we're going to have to get above. 4,300 is a very, very key level that we have to get above, right? Then we can retest 44, 45, all the way up. And so those are the things that I want us to pay attention to, right? Being able to identify key levels of support, key levels, you know, of resistance in general. Because if we just go back to March of 2021, and we look at where we were, we see that we have some resistance right here. We see that you know, we have some resistance right here. We came back down. We were able to close here, and you know, we kept going higher. So 4,000 was a key level, you know, during that time, right? Let's say the last 6 or 7 months. Ooh, okay, hold on, because I want us to look at this very, very clearly, because I want us to really truly see these key levels here. And so let's look at the last maybe 6 to 7 months. Okay, what has the market kind of been doing? You know, right here in May, we came down. We were right around this 4,000 level. You know, it was support here. We were able to kind of hold it here, but we couldn't hold it long. We ended up breaking down below it. We had it became resistance, you know, it became resistance again, resistance and turned to support. So resistance turning into support and vice versa. That lets you know that we have a very, very key level. And so what am I looking for tomorrow? Like, let's just break it down and see, what am I looking for tomorrow? If we're able to break above 4,000, I'm looking for us to hold above 4,000. Can we hold above 4,000? That's something that I'm looking, and that's something that I'm paying attention to. If the market wants to bleed down and they don't like the report that they heard, I'm looking for us to come back down and kind of retreat to about 3,800, 3,700. And it's a very, very possibility that if this inflation report is bad and the earnings reports that decide to come out, you know, well, not decide to come out, but if the earnings reports that come out over the next couple of months are not good, is a very, very, you know, it's very, very possible that we could retest this level. And so, like I said, if we were to retest that level, we're talking about the market coming down about another 11 to 12% if these reports were not good, and if the CPI report is not good, and if these earnings reports that come out over the next couple of months, if they are not good, it's a very, very good possibility that we can come back down and we can retest the lows of this year around 3,500, right? And so we really just want to keep all of that stuff in mind, okay? We really want to keep everything in mind and just understand that, number one, we're not out of the woods yet, okay? You know, we're not out of the woods yet, and we've been in this bear market a very, very long time. But what we got to understand is that we got to have a long-term mindset around this entire situation. You got to have a long-term mindset if you're a long-term investor buying shares into a company. You got to have a long-term mindset if you're a swing trader. You got to have a long-term mindset if you're a day trader. Why? Because if you're a day trader and a swing trader, you're trying to improve your skill set. You're trying to improve your skill set in order to be able to become profitable and become a skillful trader and to generate income for yourself, okay? And so what that means in general is that You become a successful trader over a series of trades, right? Over a series of trades, not over one trade here or one trade there, one trade tomorrow, one trade 2 weeks from now. You become a successful trader over a series of trades. And so what is very, very important for you to understand is that when you're trading, you got to have a very, very good risk to reward ratio here. Even when you're long-term investing, you got to have a good risk to reward ratio. What amount of dollars am I risking, okay, to make money? And so when you're trading, it's like if you have a risk to reward ratio of 1-to-1, right? Pretty much like you're risking $1 to make $1 out of 20 trading days, which if on average there are 20 trading days in a month, right? Let's say on average there's 20 trading days in a month. If you have a 1-to-1 risk to reward ratio, what that means is that you're risking $1 to make $1. And to be profitable, you have to win 11 out of the 20 days if you only take one trade per day. But let's say you up it just slightly to 2-to-1. Let's say you are risking $1 to make $2, right? You're risking $1 to make $2. If you have that risk to reward ratio, then that means you only have to win 7 out of the 20 days, right? 7 out of the 20 days. That means you don't even have to be above 50% to be profitable, right? Think about baseball, right? Think about baseball. If you bat 300 as a baseball player for a career over a 10 to 15 year time span, you are considered a Hall of Famer at that point, right? Think about basketball. Like think about Michael Jordan or Reggie Miller, right? Think about Reggie Miller. Reggie Miller's career field goal percentage was 47%. He was 47% from the field goal. So what that means is that Reggie Miller missed more shots than what he took. He missed more shots than what he took. But for that metric in terms of shooting and like how good he was still very, very good as a shooter, even though the percentage was lower than 50%, right? What I'm trying to say is that during this bear market, it's not going to end tomorrow. It's not going to end tomorrow. It's not going to end next week. It might not even end this year. But the key is, what are we going to do to have a long-term mindset? What are we going to do to continue to get better, to not get fatigued, just to make sure that we are doing exactly what we need to do in order to be successful in this market, regardless of what the CPI data is, regardless of what the Fed does from an interest rate decision, regardless of a recession, regardless of whatever is going on in the economy or in the world. What are we going to do to stay focused? What are we going to do to execute? And what are we going to do to be disciplined? Look, the Fed, right? The Fed, we care so much about what the Fed is going to do. Fed short for Federal Reserve. Let's change Fed. Well, let's change the acronym, right? We talk so much about the Federal Reserve. Let's not talk about the Fed in terms of the Federal Reserve. Let's talk about the Fed in terms of focus, execution, and discipline. That's what we got to lock into. That's what we got to break down to be very, very successful this year in this market. And so everybody, thank you for tapping in with another episode of the Trade for Yourself podcast, y'all. Please make sure you like this. Please like this, okay? Please subscribe. My goal, and I'm going to continue to add value to help break down the stock market principles to you and help you get into the stock market, okay? Make sure you subscribe. Make sure you go review all my past episodes, because it's going to be very, very important, because I'm going to continue to add value to you all and help you all in this stock market journey. Remember, don't pay for it, trade for it. I'm gonna tap in with y'all next week. Peace.